I just want to remind you all that if we're going to see continued improvement here in our labor market, we're going to need to continue to be safer at work. All of you will hear in the labor market data, and you can see as you observe what's going on in our economy, that we have been starting and stopping reopenings. And we are seeing numbers going, excuse me, in the right direction health-wise in the last couple of weeks. So we can anticipate the ability to reopen certain additional sectors of our economy in the weeks and months ahead. But if we want to see these labor market numbers continue to get better, if we want to see more of our neighbors who've been displaced from their employment become permanently reattached to their employment, we need to be safer at work. So I would direct you to our LA COVID-19 community connectory at the LAEDC website. You can just visit our laedc.org website, add a /coronavirus, and you'll see information about how you can be safer at work, as well as about the many loan and grant programs that are available. And I'll just quickly add that there are new ones coming online almost every day. We update our site every day with new programs that are coming from the private sector, from the philanthropic sector, and from our government sector. And notably, LA County and LA City have been doing remarkable work providing loan and grant capital in recent months. And the county, I believe as soon as August 31, or certainly sometime that week, will be launching a new $60 million round of grants. What we heard from the thousands of businesses that we have been connecting with at the LAEDC is that loans were still debt capital. They were adding to a small business's debt and to their liabilities and to their obligations. And with unclear revenue horizons, taking on debt even at a very low interest rate was still a daunting prospect for small businesses, particularly micro enterprises, particularly relatively undercapitalized businesses in low-income communities and communities of color. So we and many others like us encouraged our partners at the county to try and find grant capital for these businesses. And they have allocated $60 million of their CARES Act funding that the county received to a grant program for small businesses. By the way, they have separate grant programs for arts-related businesses, for childcare-related businesses, and others. But this new program will offer a series of grant opportunities to small businesses, micro enterprises, community-serving nonprofits, and others in the coming weeks. That is a considerable amount of capital. So if you or any of your clients or any of your family or friends are in need of grant capital, please visit our connectory website for information on the program or the county's own websites for information on these programs. With that said, I'm excited to turn it over to the director of our Institute for Applied Economics, Shannon Sedgwick, to give you the latest update on how our neighbors are faring here in the county, because this has really been a pandemic that has dislocated hundreds of thousands of our neighbors. And these have very human impacts, and we're trying to regularly study who has been impacted and how to help inform those who are endeavoring to provide relief and recovery resources to our neighbors as well as the businesses that employ them. So Shannon, the platform is all yours.
Thank you, Bill. Good morning, everyone. Thank you for joining the LAEDC for today's monthly economic briefing. I hope that you and your families are continuing to keep well, stay safe, and to social distance and wear your masks as we continue to make our way through the coronavirus pandemic. Just a little update on where we stand as of today. 2020 continues to disappoint. So far, the year has given California the coronavirus, the almost immediate resulting economic recession, the hottest temperatures on the planet in this century, wildfires burning across our Golden State, with casualties that include redwoods more than 2,000 years old in California's oldest state park, and rolling blackouts as electricity demand peaked, with everyone's AC units cranking while many work from home and our children are remote learning. I'm afraid to ask what's next. But with that said, today I'm going to go over the latest local area employment situation in LA County with some good news there. And we are going to take a look at more recent data on the characteristics of unemployment insurance claims filed. We typically start off with a recap of the number of COVID-19 cases, so let's start there. Over the weekend, the Los Angeles County Department of Public Health reported that we were reaching towards 232,000 positive cases of COVID-19 across LA County, with over 5,500 deaths. There are currently over 1,200 hospitalized, of which 33% are in the ICU. And 92% of the people who have died from COVID-19 had underlying health conditions, most commonly hypertension, so high blood pressure, and diabetes, followed by neurologic conditions and cardiovascular disease. On Friday, Public Health reported the total cases of multisystem inflammatory syndrome in children reached 25 cases with 0 deaths. This is a condition that affects children under 21 years of age who have been exposed to COVID-19. Inflammation can occur in the heart, lungs, kidneys, brain, skin, eyes, or gastrointestinal organs, and there can be a lifelong health impacts. And further exposing some of the inequalities that have been laid bare in social determinants of health that put racial and ethnic minority groups at increased risk of getting sick and dying from COVID-19, the majority of these cases, 68%, were Latino. When it comes to new daily cases, last month we were experiencing a spike in new cases, but the number of new daily cases has declined in recent weeks. Yesterday, the Los Angeles County Department of Public Health confirmed 1,098 new cases of COVID-19, and younger residents continue to make up the majority of positive new cases. Those between the ages of 30 and 49 years old had the highest number of new cases among all age groups in LA County. LA County has to meet 6 indicators established by the state to determine their progress in slowing the spread of COVID-19, including testing capacity, community spread, COVID-19 hospitalizations, and hospital capacity to care for COVID-19 patients with adequate numbers of available ICU beds and ventilators. Currently, LA County is meeting 5 out of 6 indicators, only failing to meet the threshold of having less than 100 cases per 100,000 residents. Our case rate per 100,000 people was 218 over the weekend. According to the latest data, the California Employment Development Department has processed over 10.6 million claims since the pandemic began in mid-March. This includes standard claims as well as those filed through the separate Pandemic Unemployment Assistance or PUA program and extension claims. Please take a second to note the scale of this economic crisis, as this number is almost triple the number of claims processed in the highest year of the Great Recession, when 3.8 million claims were filed in 2010. From mid-March to July 25th, close to 1.9 million unique unemployment insurance claims have been filed in Los Angeles County. That's roughly 35.4% of the labor force. And while initial UI claims in the early months of the pandemic were predominantly new claims, more recently, the EDD has seen a marked uptick of additional claims as workers who filed new claims when the stay-at-home order went into effect, then went back to work when it was lifted, were laid off again as new mandates were imposed before the benefit year period of their first claim expired. So 57% of regular initial UI claims were additional claims the week ending July 25th. And this is compared to approximately 5% during the earlier months of the crisis. The additional $300 to $600 in federal pandemic unemployment compensation, or FPUC stimulus, propped up consumer spending. However, those payments ended on July 25th. Without FPUC, the potential median weekly benefit amount drops down to roughly $339 a week, and less than a quarter of the California median family income of $86,165. For context, the Department of Housing and Urban Development defines very low income as 50% of the median. Without FPUC or other supplemental benefits, all claimants are below this threshold. California is currently waiting for approval from FEMA to participate in the Lost Wage Assistance Program, which would provide a supplemental payment of $300 per week for a limited period of time for claimants currently eligible to receive at least $100 per week in benefits and who have self-certified their status is due to disruptions caused by COVID-19. Back in March, we shared demographic data for initial UI claims filed in California. More recent data has been released covering the period of mid-March to July 25th. And we use this data to better understand how different types of workers are experiencing the impacts of COVID-19. The COVID-19 crisis in the labor market continues to have a disproportionate impact on women, younger workers, lower educated workers, Asian workers, and Black workers, who are more likely to be concentrated in industries such as food service, retail trade, and hospitality that have been most directly affected by the pandemic. You can see that young workers have been disproportionately impacted. 39% of workers who are 16 to 19 years old in the labor force have filed an unemployment claim. For those in the labor force who are 20 to 24 years old, close to 45% have filed an unemployment claim. Workers with a high school diploma or GED have been hit hardest, with almost 50% of those in the labor force with this level of educational attainment filing a UI claim. This compares to 6.2% of those with a graduate degree filing a claim. There are also marked racial and ethnic disparities. For example, 25% of those who identify as Asian in the labor force have filed an unemployment claim. Similarly, 32.8% of all African Americans in the labor force have filed a claim. On Friday, new employment data for LA County was released covering the month of July, and we're going to discuss that now. Here we have the monthly unemployment rate in Los Angeles County throughout the pandemic. Payroll employment was hit hardest in April and May, with the unemployment rate reaching over 20% each month. Since then, the employment situation has improved in the county, with July's unemployment rate falling to 17.5% from 19.4% the month before. Civilian employment increased by 74,000 over the month, reaching 4,064,000 in July, while unemployment decreased by 95,000 to 863,000. July is the second consecutive month the change in LA County's unemployment rate was positive. It fell by 1.7 percentage points from June, though it is still 13 percentage points higher than July of last year. If we look at the trend of LA County's unemployment rate over the last year, we see that the county's rate is significantly higher than the state and national averages. LA County's unemployment rate was 7.3 percentage points higher than the US rate in July. And we'll dive deeper into that in just a minute. April labor force data was the first full month to reflect the safer at-home order and the closure of non-essential businesses. And we saw unemployment spike precipitously, followed by an increase in May. Since then, the monthly unemployment rate has been declining. From June to July, non-farm employment in Los Angeles County declined by 3,600 jobs after 2 consecutive months of growth. As of July, we have recovered about a quarter of the 716,000 jobs lost in LA County over March and April, a net growth of 177,000 jobs. Government payrolls were down 38,000 jobs due to a seasonal reduction in public education for summer break, and private education services were down by 6,700 jobs. Accommodation, wholesale trade, food services, and construction posted small losses over the month. Job growth was reported across the remaining sectors, except mining and logging, which was unchanged. Other services added 7,700 workers to their payroll, followed by retail with 7,500 jobs, and healthcare and social assistance, and arts, entertainment, and recreation, adding 7,000 and 6,200 jobs over the month, respectively. We again see that year-over-year employment in LA County is still down significantly. Non-farm employment has fallen by almost 425,000 jobs year over year. It's a decline of 9.4%. Food services employment is down by 112,000 jobs, a drop of 28% from July 2019. A decline in employment services, which includes staffing agencies, of just over 23,000 jobs from last year, is leading the job loss of more than 50,000 in professional and business services. Across all LA County industry sectors, we still find employment levels down from 2019. A question we often receive is why the unemployment rate is so much higher in LA County. There are several factors that contribute to this. The composition of the industries or economic base here in LA County has a huge part to play, as does the differences in stay-at-home orders and reopening process. LA County had a large share of industries with the most risk of job loss, including retail and hospitality industries. Close to 46% of jobs in the county are in high-risk industries, which have been disproportionately hit due to mandated closures and new guidelines for doing business. Additionally, LA County accounts for a significant share of California's employment in industries that were hard hit by the pandemic, including the motion picture and sound recording industry, the arts, entertainment, and recreation industry, and the retail trade industry. These large concentrations of industry translate into job losses of greater proportion. Since I started off with a disappointing recap of 2020, I want to make it a point to highlight the good news covered today. The number of new daily cases is declining, and LA County is meeting 5 out of 6 state indicators tracking progress in slowing the spread of COVID-19, which is required for a successful reopening. The LA County unemployment rate declined for 2 consecutive months, bringing the rate down from 21.1% in May to 17.5% in July. Payroll employment increased across all industry sectors from June to July, with the exception of educational services and government, whose declines were related to seasonal factors as schools were out for summer break. And finally, the unemployed may be thrown a lifeline if FEMA approves California for the Lost Wages Assistance Program, which would provide a supplemental payment of $300 per week for eligible claimants. Our associate economist, Tyler, is joining us again today to share some additional information.
Good morning, everyone. It is a pleasure to be with you again this morning. This morning, we are going to tackle a subject somewhat new to these presentations, in that I will be covering some of the recent trends in the financial markets, especially the major stock indices, and the perceptible disconnect between the perceived Wall Street bullishness and the broader sentiments about the macroeconomy, especially those just shared by my director, boss, and colleague, Shannon. Though loosely connected, I will be concluding some of my remarks on the regional housing markets, which have also been somewhat bullish despite concerns about household solvency and still record unemployment levels. So I don't really think I need to explain this title, but the point is that while interest rates remain low and there is some strength in certain industries throughout this pandemic, the bullishness of Wall Street has belied the economic hurt being felt by millions of American households, including our own California households. As such, I think this is a great disconnect between how certain indices and companies have performed during the pandemic and how the broader macroeconomy has fared during this crisis. And so just to cover ourselves, this presentation does not constitute financial advice. To invest, please consult a financial advisor, and remember that past returns are not indicative of future results. So to start briefly with interest rates, the federal funds target rate is set to be mandated at 0 to 25 basis points, or 0% to 0.25%, per the Federal Reserve Board's July 29th meeting and press release. Now, due in part to this monetary stimulus through Treasury purchases through the Open Market Committee and investor desire for security, Treasuries remain at record low yields. 30-year fixed mortgages also remain at record lows, though with a small increase between July and August. Now turning our attention to the big three stock indices, all three have largely recovered since the darkest days of March, with both the S&P 500 and NASDAQ Composite exceeding pre-pandemic highs. Indeed, the NASDAQ Composite broke a historic record on August 6th by exceeding 11,000 points. The S&P 500 also broke a record on August 18th, exceeding 3,389 points, and then broke another record last week by closing at 3,397 points. Looking at the normalized performance of exchange-traded funds, or ETFs, pegged to each of the three indices and the Russell 2000, which is a major small cap index, all have performed positively since the beginning of the year, but both the NASDAQ and S&P have performed in double digits since the beginning of the year in terms of normalized average returns. Now, looking at commodities, as has been well publicized, precious metals have performed strongly since the beginning of the year, with gold and silver registering double-digit increases in price per ounce since January, as investors have rushed to traditional safe havens during this economic crisis. Oil, however, has not yet recovered from the Saudi-Russian price war earlier this year and remains about a third less in price per barrel compared to the beginning of the year. Diving more deeply into the story behind the performance of the major indices, especially the S&P 500 is weighted by industry sectors, with the majority of the index composed of technology, healthcare, consumer discretionary, and communications companies. As you can see in the graph, consumer discretionary, healthcare, and technology sectors have performed the best since January. The worst performer was, echoing the previous slide concerning oil, energy, with double-digit index losses since the beginning of the year. Now, both the S&P 500 and NASDAQ Composite, of which the NASDAQ 100 accounts for 90% of the composite's movement, weight the stocks that compose the index. For this and the next slide, the companies included are the top-weighted companies in each index. For the NASDAQ, the performance of Tesla, NVIDIA, Amazon, Microsoft, and Google have been instrumental in driving the index to record highs. For Amazon, Google, Microsoft, and NVIDIA, telework and safer-at-home orders and the changes in household and consumer decisions have undoubtedly played a role in their performance and recent success. Similar trends have driven the S&P 500, with Tesla, Amazon, Google, and Microsoft with the highest performance since January. Facebook and Google have also performed well, with modest gains for Visa, Johnson & Johnson, and Procter & Gamble as well. Now, despite the pandemic, 2020 has been a year for market cap records. Looking at the top companies for both the NASDAQ and S&P 500, these companies, which I think we could refer to as US national champions, have reached record highs for market capitalization. This year, Apple became the first $2 trillion company by market cap, with Amazon and Google in the $1 trillion club. At varying dates, all 13 companies on this list have reached market cap highs in 2020. Notice that all these companies are focused on household consumption, technology, payment systems, and communication. The notable exception is Tesla, which analysts have focused on their investments in China as being a key driver to its stock value gains in the last several months. Tesla's gains might also be a little bit forward-looking, as investors also contemplate a potential administration change in November. As we wrap up our conversation this morning, let us look at the disconnect between consumer and business sentiment. Since March, consumer sentiment has fallen to record lows, with the index at 72.8 in August. By contrast, both manufacturer and non-manufacturer business sentiment has largely recovered, with both entering into expansionary territory, that is, going above 50 in the index as of June. As most parts of the country continue to enter into varying stages of reopening, purchasing managers are experiencing the same exuberance as investors, whereas households are remaining much more bearish as they grapple with income shortages and unemployment. And finally, as promised, some real estate. Though still increasing, rents have appeared to actually start to level off in the 3 metro areas making up the 5-county Southern California region. Now, looking more tellingly at the rate of change of rent prices, rents in coastal Southern California, especially in Los Angeles and Orange counties, have dramatically slowed in terms of rate of increase. This is less true of the Inland Empire, which has likely become more attractive to renters and homeowners alike as a region with lower density and increased space. And to wrap up with home prices, compared to the change in median home prices between 2018 and 2019, all 5 counties have seen a greater rate of increase in home prices except LA County in the last 12 months. As has been reported, home sales are up despite the decrease in new stock remaining muted. Again, the pandemic has put a premium on space. So housing markets in less dense areas of both the Southern California region and beyond have been hotter than denser urban areas like Los Angeles. And as some final thoughts, interest rates remain low, and the forward guidance from the Federal Reserve Board seems to maintain that this will remain the case unless inflationary pressures prompt upward adjustment. Investors are seeking both yield and security, prompting increases not only in major stock market indices, but also increases in prices for gold and silver. As I said, national champions have posted records for market cap, especially in the last several weeks, and strong performance has existed in sectors that have reportedly done well through the pandemic, especially in comms, technology, and consumer discretionary spending. Industry and markets remain much more bullish than consumers and households for a lot of the reasons I enumerated and Shannon enumerated. And rents also appear to be stabilizing, if not slowing, though non-LA housing markets appear to be hotter than LA housing markets as people seek additional space, especially as they continue to work from home. That said, thank you for being with us this morning for this economic update, and Bill, Shannon, and I look forward to your questions.
Excellent. Thank you so much, Bill, Shannon, and Tyler, and thank you for trying to leave it on a somewhat uplifting note. So we're going to go ahead and get started with some pre-submitted questions that we did have, and then we'll dive into some of the live Q&A. So once again, we encourage everyone to submit your questions in the Q&A feature at the bottom of your screens. The first question we have, and Tyler, I think you may be fielding this one for us. How does the LAEDC see the effect on FDI into LA?
I'm going to do the classical economics on one hand, but then on the other type answer for this one. So on one hand, we've seen a lot of Chinese investment, which has formed the backbone of FDI in LA, especially in terms of direct cash transfer, not necessarily FDI in terms of companies, dry up for obvious political reasons and the continuing fraught relationship between the Trump administration and the government in Beijing. So a lot of that has disappeared over the last couple of years. That said, we've actually seen FDI go up a little bit in the last year, as you can see from some of our FDI reporting, especially on the firm count, if not necessarily on the employment count side. Also remember that USMCA was passed by all 3 signatory countries, became law in all 3 signatory countries in June. So that actually might then counterbalance a lot of the declines we've seen in our relationship with China on both the trade and FDI front. Especially since both Canada and Mexico constitute our 2 largest export markets as a state. So on one hand, a little bit of withdrawal. On the other hand, we might be seeing some opportunities for increase. So it'll be interesting to see what happens in the next 6 to 12 months.
Excellent. And somewhat related to that question, as well as connected to affordable housing, has there been any further discussion imposing a tax such as they have done in Toronto on foreign purchasers of real estate in LA?
There was some conversation about a vacancy tax in the city of LA as of last year, but like so many other things, the pandemic and responses to it and the associated economic crisis took precedent. To my knowledge, it's still potentially on the agenda for the LA City Council to consider a vacancy tax. And part of the impetus behind the vacancy tax wasn't just to disincentivize perceived wasteful foreign investment in the housing markets and artificially keeping vacancy rates high. Part of it was actually to do a fact-finding mission. That is to actually figure out what vacancy rates truly are and what they truly look like in the city of LA. But again, to my knowledge, no additional traction has taken place on that issue since 2019.
Excellent. We do have a question that came in here to switch topics gears a little bit. From your research for Shannon and Tyler, are you seeing that there are some areas of LA improving faster than other areas?
I mean, that depends on how you qualify improve. I would say certainly that based upon some of the PPP numbers that we saw coming back and based upon where industries are located, unfortunately, I think from my vantage point, it's going to be one of those stories where, again, it's the West Side, that sort of Burbank, Hollywood, Glendale area, Beverly Hills, and possibly a little bit of the valley up into the Thousand Oaks area and the border with Ventura that are going to be the ones to recover fastest because they exist in those industries that have been most resilient. So that is to say communications, information technology, some healthcare in there, industries like that. Though we've seen other areas of the county do well as manufacturers have pivoted more to PPP. So there's been some gains, especially in like the San Gabriel Valley and areas like that with companies that have been more resilient. I don't know if Shannon, you wanted to talk a little bit more.
Well, we also have to remember when we first started looking at the pandemic, we identified that across the county, there were different areas that were being impacted to different degrees. So you had South LA had a large number of small micro businesses and a large number of employees that worked in industries that were hardest hit, including retail, food service, and arts and entertainment. So some areas have a lot farther to go in terms of recovery than others. So it's likely that you're going to see that through the recovery, there will be, as Tyler said, West LA and other areas that have a large concentration of industries that weren't hardest hit, that they'll likely recover faster than those areas that were.
Thank you. This is along the same frame, so we're going a little off script today. But are opportunity zones having an impact, and where are the dollars being invested? Or have you seen any evidence? Oh, Bill, you're on mute. Let me unmute.
Yeah, I was just unmuting myself there. The only opportunity zone that I'm personally aware of that is seeing significant investment is the SOLA Impact Funds Opportunity Zone in the old Goodyear tract in the city of Los Angeles. Martin Woto is the principal behind the SOLA Impact Fund, and that I think is the nation's first industrial opportunity zone up and running. So there has been significant investment there. I don't know if our economists know. We can certainly get back to you if there are other areas where there is significant opportunity zone activity happening in LA County. It has been restricted somewhat by the state of California's choice not to align state tax policy and legislation with the federal opportunity zone legislation. That has diminished some national interest in investing in California and has held back some potential investment we would have liked to have seen here. But we can certainly look into more of that.
Thanks, Bill. So we're all over the map today with these questions, but I love it. The next question we have, and this one was pre-submitted, what are upside and downside risks for the region from the state's ambitious carbon reduction goals in terms of grid reliability and opportunities for local renewable energy firms?
I'll take the answer, but I'll give credit where credit is due. One of our great colleagues, Lauren Markle, helped us this morning. He's something of the resident expert, especially on alternative energy. But based on his response and my own reading into the issue, I mean, the biggest challenge right now is how do we capture that excess energy being generated during the day by wind and solar sources. It's been really a challenge to find new and innovative solutions for energy capture and for energy storage. That said, we as a region and we as a state are very well posited in terms of industry concentration and also R&D to capitalize on a lot of the businesses that are focused on energy storage, battery development, energy capture R&D, to continue to produce the cutting edge and provide those solutions for our state. Especially as we spend more time at home, there's been increasing emphasis on looking at households as sort of individualized nodes for energy capture and to become almost microgrids in and of themselves. So I think that it's one of those things where if I were governor 10 years ago, and this is just me talking, I'm not speaking on behalf of the LAEDC, I might not have as quickly shut down as many nuclear power plants as possible in order to provide, at least for the medium term, some transitional energy sources to help us through that sort of growing pain phase and to truly make us a sustainable and green energy state. That said, these are growing pains. And they are solvable growing pains. So I think doubling down on the investments we've made as a state and as a region into a lot of that battery technology, and then also thinking about our own energy consumption decisions, I think this will be overcome. So.
Excellent. And we have time, it looks like, for maybe one, maybe two more questions. Trying to choose so many today. Are home price increases consistent across the county, both by neighborhoods and price thresholds?
No is the answer. Tyler may have more to respond, but no, they are not consistent. I think the number in Shannon or Tyler's chart, I think, was 1.8% increase, but that is not consistent across the county or price points. Tyler, I don't know if you have any market segmentation information.
Again, it's sort of a thing about multifamily versus single family. Obviously, that's going to be a little bit of a difference across the county. We've seen increases in multifamily or single family across the board. I mean, that goes with reasons because people want space. Obviously, the west side is still more expensive, but we've seen increasing growth in San Gabriel Valley and in the valley increasingly, and then out into the Inland Empire, people continue to look for single family homes. On the rental side, things are a little bit different. So we've seen where I live on the west side, things remain stable pretty much in terms of rental prices, but we've seen actually some decreases towards the downtown area, especially as more and more people are working from home, and a lot of people who work downtown don't live there. But also because a lot of these luxury markets are starting to struggle somewhat as people grapple with unemployment and with income struggles. So prices are actually decreasing the farther east you go in terms of rental prices in the county.
Thank you. And with only a minute left, I actually want to leave some time just in case for closing remarks before I close this out. So Bill, Shannon, Tyler, any closing remarks from y'all?
I would just add what I began with, which is, as you can see, this data has some good news in it and some discouraging news in it. And part of that relates to the variability, the unpredictability of the course of this virus. The best thing we can do to ensure economic recovery of this region is to keep each other healthy, to get control of this virus, to get that sixth indicator that Shannon referred to back in line so that we can come off the state's watch list and reopen more segments of our economy. But when we do, that we can do it safely. So we were all safer at home in the spring, but when we went back to work, we did not behave as safely as we could have, and there were resurgences in the virus's spread. So our message from you at the LAEDC, from us at the LAEDC to you, is be ambassadors with us for a safer at work campaign to ensure that we protect our employees, our customers, our suppliers who visit and interact with us. We are all in this together, as people repeatedly say, as something of a cliche, but there is a role for each of us to play. Sometimes it's a simple role of just wearing a mask, being socially distanced, washing our hands. Sometimes it's a more specific role in terms of how to keep our workplaces safe, how to spread this message. The LAEDC will be endeavoring to spread this message of being safer at work in the months ahead, because it's going to be several months more before we have the necessary therapeutics and vaccines to ensure safety amongst the broader population that is still suffering health impacts and economic impacts. So that's our final message. There's some good news, as you heard from both presenters, in some of the numbers, but to ensure that good news continues and we have a more robust recovery in the months and years ahead, we've got to be safer at work. Thank you for visiting us, as always, for these monthly webinars now. You can always go to the LAEDC.org website to find these webinars and to find other research we're doing, or to send us questions, or to seek assistance through our community connectory at laedc.org/coronavirus. Thank you.
Excellent, and thank you all. And just as a reminder to our viewers, please keep an eye out for that email with a link to the recording, as well as a link to the registration for the next economic briefing on Monday, September 20th at 11 a.m. As Bill said, we encourage everyone to visit our COVID-19 response page for advice and resources at laedc.org/coronavirus. And as always, if you have any additional questions, we've seen them coming through the chats and the Q&A feature, and we'll do our best to answer those in the coming days. Please submit those and send those directly to myself at shane.cullen@laedc.org. Thank you again for joining us today, and we wish you all a safe and happy week. Have a great day.
Thanks, everybody.
Thanks, everybody. Be well.
Thank you.